What is the Principal Residence Exemption? The Principal Residence Exemption is one of the most significant tax benefits for most Canadians, as it can eliminate or reduce the capital gains tax you would otherwise have to pay when you sell your home, principal residence. As such, understanding the intricacies of the Principal Residence Exemption is crucial for Canadian homeowners to ensure they meet all the requirements and maximize their tax savings. Normally, when you sell a capital property, such as real estate, for more than you paid for it, the profit is considered a capital gain, and a portion of this gain is taxable. However, if the property you sell is your designated principal residence, you may be able to shelter the entire capital gain from tax. This is the essence of the Principal Residence Exemption. For a property to be eligible for the Principal Residence Exemption, it must meet several conditions set by the Canada Revenue Agency. Ownership. You must own the property either solely or jointly with another person. Housing unit. The property must be a housing unit, which can include a house, apartment, condominium, cottage, mobile home, or even houseboat. The land on which the housing unit stands, up to 1.5 hectares, approximately 1.24 acres, is also generally considered part of your principal residence. Ordinarily inhabited. You, your current or former spouse, or common law partner, or any of your children must have lived in the property at some point during the year for which you are claiming the exemption. Even short periods of habitation can satisfy this requirement. Designation. You must designate the property as your principal residence. It is important to note that a family unit, you, your spouse or common law partner, and your unmarried minor children can only designate one property as their principal residence for a given year. You officially designate a property as your principal residence in the year that you sell it or are deemed to have sold it. This is done by completing and filing Form T-2091 IND, designation of a property as a principal residence by an individual other than a personal trust with your income tax return. If the property was your principal residence for every year you owned it, the process is straightforward, and you will likely be able to exempt the entire gain. Since 2016, the Canada Revenue Agency requires that you report the sale of your principal residence on your income tax return to claim the exemption. This is done on Schedule 3, Capital Gains or Losses of your T1 income tax return. You must report the year of acquisition, the proceeds of the sale, and a description of the property. Failure to report the sale can result in the Canada Revenue Agency disallowing your claim for the primary residence exemption, which could lead to a significant tax liability plus penalties. The primary residence exemption calculation includes a +1 rule in its formula. Exemption equals capital gains multiplied by number of years designated as principal residence +1 divided by number of years owned. This extra year in the formula is beneficial when you sell one principal residence and buy another in the same year, allowing both properties to be eligible for the exemption for that year. The tax implications can become more complex if you change the use of your property from principal residence to income producing, such as a rental. When you change the use of your property, you are deemed to have sold it at its fair market value. You can elect to defer the capital gain tax by filing a Section 45 Sub 2 election. This allows you to designate the property as your principal residence for up to 4 additional years, even while it's rented out, provided you don't claim any capital cost allowance, depreciation on the property. From income producing to principal residence. Similarly, when you change a rental property into your principal residence, there's a deemed disposition. You may be able to make a Section 45 Sub 3 election to defer any capital gain until you ultimately sell the property. If you only rent out a portion of your home and the rental use is ancillary, you don't make structural changes, and you don't claim capital cost allowance, the Canada Revenue Agency may not consider a change in use, and the entire property may still qualify for the primary residence exemption. Given the significant tax implications, it is highly recommended to consult with a tax professional when dealing with the sale or change in use of a principal residence to ensure you are compliant with all Canada Revenue Agency regulations and are taking full advantage of the available exemptions. Thank you.